Welcome back to Success with Steven. My name is Steven Smith. On this channel, we talk about financial literacy, business credit, personal credit. We talked about FHA loans, and today we're going to be getting into something we have not touched on before, but something I spent at least 4 years on. And this was my primary source of income for a while, and that is going to be stock trading. But this will be a video on stock trading 101. It's going to be stock trading for beginners. This was the way that I began stock trading when I was first introduced to it. And I want to make this video so easy that you could show this to a 9 or 10-year-old and they could grasp how to actually start trading in the stock market. I will do another video on investing later. I still plan on doing a video on ETFs. And if this goes well, I'll continue to put out more videos because this will not cover everything. I will try to cover as much as I can about the basics. And later on, I'm going to probably cover different strategies, different platforms. This is, again, exactly how I started out. But eventually, by the time a couple years went by, I was using trading views. I was purchasing indicators, which are things that tell you when to buy and sell stock. As you get more advanced with this, you'll start to get familiar with these other tools and resources that people use once they've become a little more advanced. But without further ado, I'll get right into the video because this will probably be a long one, and I want to make sure that, I'm not wasting anybody's time. Now, what are stocks? And again, we want to start from the beginning, and everything that I say, I'm not going to cover in depth. Be on the lookout. I may do like a comprehensive guide for a couple of these definitions if you want to be able to refer back to them. That way it'll make more sense when you watch this video. But a stock is a piece of a company, also known as shares, that signifies ownership and claims part of the corporation's assets and profits. So companies offer stocks to investors to raise more capital. More capital means more operation, and which in turn should equate to more profit. And when you buy a share of a company, you are a minority owner in that company. So, for example, if 1,000 shares of Starbucks were issued, you would be a 1/1000th owner of Starbucks. So usually when you have companies that go public, it's called an IPO. They're usually trying to gather money and resources so that they're able to expand. And usually from that, you'll have people like me, people like you, who will buy into these companies that we normally go to, we use every single day. And the money that we provide to them will just help fund their business. And in turn, it'll help make everyone profitable. All right. How do companies issue stock? So companies sell their shares to the public through a stock exchange. And this is a market where securities are bought and sold. And securities is it's a broad term for investments. It includes stocks, it includes bonds, it includes notes. You'll see a lot of different types of securities on the stock exchange, including like ETFs, index funds, things of that nature. The New York Stock Exchange is just one example of an exchange that we offer. There's the NASDAQ, and there's a lot of other ones. And when a company goes public, again, IPO, which stands for initial public offering, they move from being a privately owned company to becoming a publicly traded company in which we can become a minority investor in. Why should you buy stock? And again, I'm going to be going through this fairly quick because I know you guys want to get to the trading. So you give your money to some of the best companies in the world, and then as that company grows, you earn more value and it increases that company's value. So as you invest in them, their company grows, your investment grows. So it's a mutually beneficial relationship, or that's the way that it should work. These companies hire the smartest, most innovative people in the world to help them grow, sell, launch new products, break into emerging markets, and you can attach yourself to their success by investing money into their company. So another great reason to invest money into the stock market is to create passive income for yourself with dividends. We have slightly talked about dividends on this channel. That is another video that we will be getting into in the future. But my passive income video just released. I'm actually not sure how old that video was, but I will probably be pushing this video forward. As you guys know, I make usually 10. Now I'm getting to the point where there's 15 videos already scheduled. Sometimes more important videos or topics that I feel like would resonate with the community, I push to the forefront. So this video was May 9th. It is Thursday. You might possibly see this video on May the 10th. So tomorrow. Some companies share their profit with their investors by offering them payments in the form of dividends. Those are paid quarterly, which is 4 times per year. Some of them also pay monthly, but you would have to look at how the dividend payout is scheduled to know how you will be receiving those. But again, we will be getting into dividends at another time, but this is just one of the reasons why you should be purchasing stock right now. All right. There are 2 types of investments. One is capital appreciation. So capital appreciation is the type of investment that rises in investment price. So buying an asset at a price to make a profit in the future by selling it at a higher price later. That is capital appreciation. So for example, if you buy a house in an emerging market for $400,000, years later, you sell it for $720,000. The profit that you made on that house would be capital appreciation. Now, if you invest, let's say $5,000 into Tesla stock at $150 per share, 2 years later, the stock is $300 per share. Your investment has now grown to $10,000 per share because that was a 100% increase. Essentially, you doubled your money because the price of the stock doubled. All right. The second type of investment is cash flow. And these are both 2 types of investments that, of course, we want to be familiar with. So owning an asset and receiving reoccurring payments regularly. So real estate investment, in addition to buying properties, that's one type of investing, right? But in addition to buying properties and leasing or renting them out to tenants, investors can participate in real estate investment trusts. These are called REITs. So real estate syndication, also known as real estate limited partnerships, they're called RELPs, RELP, and they also provide several of the benefits of owning properties without many of the concerns that landlords face. So think about REITs and RELPs as you investing, as you buying stock of property. It's essentially, that's the exact thing that it is. So income from real estate investments, they're usually derived from rent payments or some type of term where someone's paying to stay in your property, unless it's commercial real estate and they're using it for business purposes, but about the same. So it's derived from rent payments from directly owned properties. REIT and RELP investors, they receive a dividend, and the amounts vary according to the type of property. So they also get a share of the profit when a property is sold. So if you wanted to be actively investing into property without having to actually own a property, this may be something that you might consider, and you can purchase these on the stock market. If there's enough interest in that, I could look at talking about that or getting to that more in depth at a later date. And of course, stocks. So dividend stocks are usually classified as either common or preferred. Preferred stocks pay a consistent, predetermined amount over a specific period of time. Their dividends are also paid before those of common stock. However, while preferred stock represent guaranteed payments, common stock hold the potential to pay more because their amounts are not predetermined. On the other hand, there could be instances in which common stock do not pay at all. So you just want to keep that in mind. Preferred stock is usually going to be the safer option. If you're young and you want to take on more risk, then you could look at common stock, which could pay you a higher amount other than what they originally said they would give you. But on the flip side, you may not receive anything at all. It just varies and depends. And that's just, I just want you to understand that there are stocks that you can buy where you're not just purchasing and selling. There are stocks and types of securities that you purchase where they will continuously pay you money other than just selling them at a higher price. Okay. Now, this is really big. For around 4 years, I did swing trading. I started with day trading, and then I moved to swing. The other type of investing is long-term hold, or that's the traditional method of investing. And we're going to talk about what the differences are. Now, swing trading. Swing trading is a style of trading that attempts to capture short-term to medium-term gains in a stock market over a period of a few days to several weeks. Swing traders primarily use technical analysis to look for trading opportunities, which we will get into. Now, here's the great thing about swing trading. You can purchase a stock at, let's say, $20, and there can be a reason. Maybe it's earnings are coming up. Maybe it was a news event, but it could be something that you have an inkling that this stock will go up in price. And let's say it goes up to $40. You can double the money when you buy at 20 and you sell at 40. Swing trading essentially is when you buy a stock and you hold it for longer than a day. If you buy a stock and hold it for longer than a day, but sell it in less than a year, that's a swing trade. That's my definition of a swing trade. If you buy one and you hold it, in my opinion, longer than a year, that becomes an investment. If you buy it and you sell it in the same day, that is a day trade. So swing trades can be more risk. The returns are quick though. Of course, you hold stocks longer than a day. They do require time and attention, and you sell your position for a profit once you hit a target in a shorter time frame. All right. I like swing trading because when you're looking at a chart, the longer the time frame, the more accurate the data can be. When you're looking at a day time frame, things fluctuate very, very quickly. And, it's something where you have to also watch it a lot longer. You have to pay attention to that, and not a lot longer per se, because you can make a quick trade in the moment the stock market opens up, and then by the first 30-40 minutes you could be done potentially. It just depends on your style of trading. But I do think that there is a better upside to swing trading if it's done properly. Now, investing is what I've been doing as of late. Investing has way better benefits, I will say, over the long term. I think the reason why a lot of people who are young may not want to invest is because they think it takes too long. But I don't really know how else to say this without sounding the exact same as everybody else that will say it. But investing in the long term is the best thing that you could do. I'm not saying you have to do one or the other. I still swing trade now every once in a while. I swing trade the same way I do Amazon FBA. It's just passive when I see great opportunities. So I don't have to choose between one or the other. I do both. But I also want to, not have to spend too much time handling these things. So investing is a long-term strategy focused on buying and holding assets for an extended period of time, typically years or even decades. The core idea behind long-term investing is to capitalize on the power of compounding returns and benefits from overall growth of these markets that we're in. Okay. And key points: it's lower risk, slow returns, compounding results, require less time and attention, long-term hold. Now, you guys know I've had a video where I've shown you what compound interest does. I've shown you where if you were to invest, $1,000 into the stock market for around 20 years, you could end up somewhere around $250,000. I am using an investment calculator that's going to be giving us a similar investment return if you were to invest into the stock market at an 8% compounded annual rate for 20 years. Now, again, think about it like this. If you were 18 and you were to invest into the stock market for 20 years, just $1,000 a month, your total amount invested is going to be $241,000. That would have been your money, right? Your ending investment balance would have been $577,321.06. So you're probably looking at this thinking like, oh, it took me 20 years to double my money. I could have just done a swing trade of that same amount. Okay, I understand that, because what you're investing is $12,000 a month and you've basically doubled your money essentially. But let me go back and break down these numbers if you were to do this for 30 years. After 30 years of investing, so 10 more years added, you went from investing $361,000, because of course there's 10 more years of you doing $12,000 a year for the next 10 years. Now your investment went from half of what it was to almost actually doubling, a little bit more than that. Now it's at 1.4 million. So this is what I talk about when I say compound interest. At some point, your interest starts to make you more money than the money you were putting in. But the thing is, you can't beat time. This actually does take time. The only way that compounding works is that it has to snowball over time. And there's no way for you could put in $1 million today. The interest will not compound, or you won't see the greatest amount of compound interest until like year 15 to 20. And then every other like 5 years to a decade, it just compounds even more. So of course, I know that at the age of 20, you don't really think about where you're going to be at 50 years old. But I believe if you were to do this, especially with dividends, it is well worth the effort. This is just a little tidbit from me. Again, you don't have to listen to what I'm saying. This is just my advice, and it's something that I wish that I would have been doing, especially if you have a business and you're making more than $1,000 per month. For people who are very ambitious, if you planned on making $80,000 a year, $80,000 a month, $83,000 a month, which would be around $1 million a year. Just imagine if you were very ambitious and you did the same thing for 20 years, but instead of doing $1,000, you did $10,000. Now look at what would happen if you did the $10,000 for 30 years. Now you're at 14 million. Again, I know these numbers look big to someone, but I know that an ambitious person will look at this and go, wow, that's crazy that I could actually do that much with 10,000 in the amount of 30 years. Now that we understand the difference between trading and investing, let's take a look at some of the largest companies in the world by company market cap. Now, a market cap is, think about it as the value of the company, right? So these are companies that you invest in every single day. How many times do you use a Microsoft or Apple computer? I'm using an Apple computer right now. How many times do you use Google every day? How many times do you order from Amazon every single day? You know, how many times do you use your Visa card, or you bank with Chase, or you drive a Tesla, or you get gas, or you go into Walmart, or you have healthcare, or you use your MasterCard or LVMH? How many of you buy Louis Vuitton and like luxury brands? And how many of you have a Samsung phone? My point is that we use all of these products and services every single day, and we give them our money, but we don't invest into these companies. Wouldn't you want to own a piece of something that you normally use every day, or that you are aware that everyone is using every single day? For example, everyone talks about, oh, I could have had this much money if you would have bought Bitcoin at this price. And really think about that. That's a real thing. If you would have bought Bitcoin at a particular price, you could have been, a millionaire by now. If you would have bought Apple at this price, you could have done, you could have had this by now. The point is that no matter what period of time that you're in, you're going to see historically all of these things repeat. there will be another company that will come around right now, probably maybe this year. There'll be something that's coming out that if you were to buy into it, it could give you great returns in the future. There's going to be something. There will always be something. As long as there's an economy, there will be something, right? You could be looking at that right now at 20 years old, and by the time that you're 40, you could be retired. For a lot of people, they would love that. By 30, potentially you could be retired. But, I want to give realistic expectations, so your kids are going to be like, yeah, Dad, where were you when this company became the largest corporation in the world? Where were you at when this happened? They're going to be wondering if you could have somehow gotten ahead by purchasing, that company. So just something to think about. Because again, we always hear that, oh, if I would have gotten this at this time, it would have been this. So I don't like to speak in hindsight. I like to be active in the present. All right. So that's what we should be doing right now. Now that we've looked at some of the largest companies by market cap, and we're familiar that these are companies that we use every single day, I want to look at this website called macrotrends.net. And please stay with me. I'm going to get to the trading portion of the video. This is important when it comes to trading, because trading is nothing but human psychology. That's all that it is. And you don't have to be a psychologist to understand human psychology. It's really two things you have to understand. One of them is fear. One of them is greed. That's the only two things that you have to understand. And the more that you know about historically the way that people think, the better that you'll be at this, even without using any what we call technical analysis. You can just kind of call it based off of historical events, right? So let's take a look at macro trends. All right, so this is the Dow Jones 100-year historical chart. And this is data that I like to look at when I want to get an idea of where the economy was, at certain times. I think that the Dow Jones Industrial Average is a really, really good way to get a pulse on what happened in the past. So let's take a look and let's, see what happened here. So every gray line that you're looking at here was when there was a historical market drop. So check this out. Throughout all of these years, and we're starting at 1915. Throughout all of these years, look at how many times you see these gray lines, right? And some of these we're aware of, right? Like some of these, if I can go back far enough, I think, let's see. I know one of these was the Great Depression. If we go to my life, what I was alive for, this was the dot-com bubble. I remember this one. This one was the 2008 real estate crisis. I was there for that one too. Then we got into a recession. Look at how long that one was. And this little blip right here was one that we're all familiar with. Pandemic. Look at how small that little blip was. But think about how everyone was thinking the world was going to end. The sky was falling, right? So if you look at this historical data for the overall market, you'll see that for the last over 100 years, things have always been increasing. No matter which way you're looking at it, most of us, God willing, will live 100 years, maybe less. If you were to put your money into the stock market, just look at this historical data. Chances are it's going to go up. It just keeps, you're not seeing the market crash and burn. So just psychologically, you should always put into your mind that overall, that's what's going to happen. Each of these events was probably an event that someone thought that the market was over, everything's over, the sky is falling. Every single one of these events were probably one of those times. But yet, we just kept moving on. And a few of these times we're familiar with. So look, even in 2008, if you would have looked at where we were, where it went down to, by the time we got back up to 2014, things had recovered, right? And then by the time we got back to where we are now in 2022, look at how far you would have come from that point. Or look at the little blip that we have right here, and then look how we've recovered almost back to where we were. But we're in another recession. I just want to give you an idea of how in times of panic over the last 100 years, look at historical data and you'll pretty much get an idea of what to expect in the future. And at the very least, with 100 years of data, I would say this is at least enough data for the lifespan of a person. And for the lifespan of an individual, I would, if I had to bank on something, I would bank that in my lifetime, this will continue. Before I pass, this will continue, this uptrend overall. If you Google a stock right now, this is what you're going to see. And I actually screenshot this yesterday, May the 7th. It is Google at $172.98. As you can see, it was up 1.85%. And after hours, it fell a little bit, about, looks like 70 cents here. If you look at the open, you'll see that when the stock market opened, it was $170.12. The high was $173.47. The low was exactly $170. So check this out right here. This is the 52-week low. So in the last year, Google was $105.79. So if you would have bought Google at the lowest price, look at the highest price and look at the current price, you would have definitely been profitable right now. And that could have been a good swing trade if you knew a good entry point. So there's also the PE ratio. That's the price to earnings ratio used to value a company that measures its current share price relative to its earnings per share, which is why people are paying attention when you see earnings report come out, because based off of that can drastically change the way we should view the price, right? So dividend yield, that's the amount of money paid out to shareholders, expressed as a percentage of a current share price. So as you can see, there is a dividend yield for Google. It's 0.46%. So all the shareholders that earn Google are getting paid this dividend yield for owning a share of that company. And we know the highest and lowest price. And again, if you were to Google any company right now and you had it's up here called the ticker symbol. It's like a short abbreviation of the company, and it's how you can find it on the exchange that the company's listed on. In Google's case, it's listed on the NASDAQ. But you would find the ticker symbol, or you could type in the name of the company, and you'll see the same information for 1 day, for 5 days, for 1 month, for 6 months, and then year to date, so on and so forth. And you can always take a look at that. You can also take a look at a company's fundamentals, where you can get into like financial statements that need to be released for that company. It lets you know that company's financial standing, and it lets you know exactly what you can expect that company to do in the future based off of this disclosed information that legally has to be provided once you become a publicly traded company on the stock market. Now, where to buy stock? So you need to buy stock from a stockbroker. Back in the day, old days, you used to have to pay a commission fee to trade stock, where let's say I wanted to buy a stock of Google, I'd have to pay $4 to buy the stock, and I'd have to pay $4 to sell the stock. So if I didn't make at least $8, I couldn't, it wasn't even any point in trading, But now there's no commission fees, and there's a lot more options to trade stock. I put on here that I don't recommend that you trade with margin. If you get one of these stocks, turn margin option off when you set up your account. Margin is basically you being able to spend more money than what you actually have. Some places had 4x margin, where, if you had $5,000, they let you spend up to $20,000. That's just an example, right? You don't want to do that. There's these things called margin calls, where if your investment drops to a certain amount, they will automatically sell all of your stocks, as well as you'll have to also pay money. If you use margin, you could end up having to pay more than what you actually have. And that could put you in a bad place. So if you're a beginner and you see this option, I recommend that you turn it off. I don't see benefit as a trader to doing that. If you buy something and you hold, eventually, if it's a good company, you did your fundamental research, that company can be valuable again and be more than what you paid for it. If you use margin and that company drops to a certain price, they're going to do a margin call, basically calling you on the money that they say that you owe. And then you'll have to not only give them possibly all of your money, you could potentially pay more. All right. So TD Ameritrade is a place that I like to use. I started with them. I also used E-Trade. I used Robinhood, Fidelity, and Charles Schwab. I've used all of these. I've used Webull too. I didn't add Webull onto there, but those are multiple different trading platforms that you can use to buy stock. I think Fidelity is really good. You probably have one of these associated with your 401k, so you could always open up an investment account with one of these places and use them as your primary stockbroker. All right, so what makes stock prices change? Basically, supply and demand, and I'm going to give you a really easy example of that. So supply and demand is a key factor in determining stock prices. The price of a stock is determined by how many people want the stock versus how much of the stock is actually available. For example, if there's 20 people that want to buy a burger, but only 5 people want to sell one. So if 20 people want something, but only 5 people are selling that thing, the cost of that burger will go up, right? Think about it. If 20 of us want it, but only 5 of us got it, most of us aren't going to be able to get that. At least 15 of us won't get it. So we're going to do this. I'll sell this burger for $10. I'll pay $20. I'll pay $30. And we'll keep raising the price until no one actually wants to buy it anymore, or the last person says, I'll still buy it. And that's the price that we're going to sell it for. That's basically what supply and demand looks like. So the demand for the burger is greater than the supply that's available of that burger. Now, imagine if 20 people want to sell a burger, but only 5 people want to buy it. The cost of the burger will go down. So the sellers would have to lower their price to get a sale, right? So if everybody wanted hot dogs and 20 people were selling burgers, but only 5 people were like, I might want that. You're going to have to make the deal more enticing for the people who are on the fence about possibly going over there and getting a hot dog. So you're going to have to lower your price. My burger was 20. Now it's 15. Now it's 10. At $10, they may be like, oh, there's something hot dogs over there for 15, $5 less for a burger. Let's go over here and grab this burger. Right? Now, imagine millions of people wanting to buy millions of shares of thousands of companies at the same time. And that's how you get your daily price action. Right? That's the movement in the stock market, essentially. All right. So fundamental factors also drive stock prices based on a company's earnings and profitability from producing and selling goods and services. So technical factors relate to a stock's price history in the market pertaining to charts, patterns, momentum, and behavioral factors of traders and investors. So essentially, there are things that happen in the world that control price movement. Remember, I was saying that the stock market is human psychology and it comes to fear and greed. That's what moves the market. it's not actually this complicated thing that people think it is. But the reason why sometimes it doesn't make sense really does come down to people being emotional. So bad earnings or sales, like for example, if Warren Buffett, which is one of the most decorated investors in the world, if Warren Buffett was to sell all of his stock in Coke, a lot of people would sell their stock in Coke. Reason being, if that guy did it, he must know something that we don't know. So if he knows something, they're gonna follow suit, right? That could be news, that could be a sign to people to do that. So bad earnings. If the company said that they projected to make $200 million and only made 100 million, they're 20 million short, that might be bad earnings where people are like, oh, okay, well, their projections are just not up to par. I'm going to go take my money elsewhere. I don't want to buy with this company anymore. They're doing horrible. Sometimes, good news can make a company go up. Sometimes investors need to liquidate. For example, if property starts to go down, you can use sometimes the assets that you have, like your stock holdings, all of your assets, and you can use that to put into your bank account to show that you could afford to pay the down payment and closing cost. So that might be a time that you notice that a lot of investors are liquidating. There are times that you'll start to learn when you look at the economy and you look at the condition of the economy, it will dictate the behaviors that people have. So fear or excitement about the economy can make people buy. Like there was a time where people were just pumping up stocks and they were going crazy for no reason. There was no fundamental reason why they should have been that high. It was ridiculous, but people were just excited about different things and it was just making them go up. So it comes down to fear and greed. The stock market does operate off of emotion. Each of us have an individual opinion, an individual thought that will push the market the direction that either he or she is willing to buy or sell. And that's pretty much it. Stock market doesn't have to be logical. It's really based off of emotions. And once you understand that, you'll probably try to stop basing things off of how you feel. I'm not going to expect you guys to remember any of this, but I do want to say it because, this is relevant. This is how you learn, this is how you learn to trade. So I'm going to tell you what this is, and then I'm going to break down how it works. Okay? It might not make sense at first, but stay with me and then I'll bring it together. So, technical analysis is something that traders use in order to determine good times and bad times to buy stock. And they use a couple of different things. One of the favorite things that I like to use is the 20-day and 200-day simple and exponential moving average. It just depends on which one that you want to look at. So simple moving average refers to a stock's average closing price over a period of time. You can calculate this yourself by taking the last 20 days of a stock price when it closed, add them all up, and divide them by 20. That's essentially what it is. So the reason the average is called moving is that the stock price consistently changes, so the moving average changes accordingly. SMA is one of the core indicators in technical analysis and is usually the easiest moving average to construct. Now, the exponential moving average is the same thing, but the exponential moving average puts more weight on the most recent dates. So that's why if you're looking at they'll call it the EMA and the SMA, you'll see they're slightly off, but just know that the EMA puts more weight on the most recent days other than the past few days in total. And you can change this to where it can be 5 days, 20 days, 18 days, 50 days. I've played with all of them and you can just see which one you prefer. In my opinion, in the grand scheme of things, they all come fairly close unless there was a dramatic shift into a stock's price. The next one is called the RSI. And again, I'm going to show you all of these. The RSI is the relative strength index set to 14 days. RSI is a momentum indicator used in technical analysis. RSI measures the speed and magnitude of a security's recent price changes to evaluate overvalued or undervalued conditions in the price of that security. So to put simply, the RSI tells you when a stock is either oversold or overbought. Okay? And again, stay with me. I'm going to bring this together and it'll make sense. Support and resistance zones. So support and resistance zones kind of show the supply and the demand. In a downtrend, if a price is falling because there's an excessive amount of supply over demand, the lower the price goes, the more attractive the price becomes to those waiting on the side to buy the shares. At some levels, that demand would begin to slowly increase, which will make the price rise. So, and then at that point, if that happens, the price is going to stop falling. Resistance is the opposite of support. So if a stock is moving up, there might be a price where everyone can agree that that's too high. And usually that price is where the stock will just stop and it'll come back down. So prices move up because there's more demand than supply. And as prices move higher, there will come a point when selling will overwhelm the desire to buy. And this happens for a variety of reasons. Again, you can't really say why it happens. You don't know why, but there's a bunch of reasons why that can happen. And I'll give you an example. If I have my phone, right? If I have my phone and I told you I'm selling this iPhone for $10,000, you're going to say, I'm not buying an iPhone for $10,000, right? So no one's going to want to buy. What if I keep dropping my price? What if I say, okay, I'm going to sell it to you for $5,000. Okay, $3,000. Okay, $1,000. Okay, $500. I'll sell this phone to you for $100. It's an iPhone 14 Pro Max, $100. You're going to buy that phone at some point, because at some point we'll reach a price that's too attractive for you to say no. It's going to be so low. You're going to say, I could sell that for way more than $100. I'll buy it. That's kind of how the supply and demand works. And think about that for support and resistance, because there will be a point where it's going to come up so high that selling will overwhelm the price. And that's when we see price drop, or you'll see a stock move sideways. And we'll get into the stock movement. Now, the MACD, that's the moving average convergence divergence. The MACD is a technical indicator to help investors identify price trends. It measures trend momentum and identify market entry points for buying or selling. Moving average convergence divergence is a trend following momentum indicator, and it shows the relationship between two exponential moving averages. So this is how I like to think of the MACD. The MACD lets you know when a lot of buying is about to begin. That's just how I like to think about it. It's volume. It's the amount of momentum that's being given to something, right? And then I'm going to show you how we use all of these things to determine when to buy and sell a stock, and I'm going to show you why it's very simple. Now, before we look at using all of these indicators and we break them down, I want to talk about the 4 stages of price movement. So stage 1 is the accumulation phase. That's where a stock moves sideways. A stock only can move 3 different ways, either sideways, which is in the same range. It can go up or it can go down. Sideways, up or down. So there's an accumulation phase. There's usually a point in the accumulation phase where you start to see a stock go up. And usually this is where we're going to use our indicators, the things I talked about, to try to catch the best time for buying. So it's like this. If you're driving a car and a car goes from 0 to 100, There's a point where the car has to get to 30 miles an hour. What we try to do is catch that 30 mile per hour point. And then when that car gets to 100, we try to find the point where it drops to 80 and we know it's slowing down. So we got, we knew when that car was going to go 30, it went to 100 and then we left it at 80. Right? So that's kind of how this works. Accumulation phase here, cars going, just rolling, starts to go up quick. Best time for buying was right there when it started getting to 30 miles per hour. Our indicators told us this thing is going 150 miles. This thing's going crazy. 30 miles per hour, we caught it. There's then a phase where, of course, like we just talked about, starts to slow down a little bit. Oh, we're just cruising at 100, but it looks like it's starting to lose acceleration. And right here, when it starts to drop down to around 80 miles an hour, that's the best time for selling. We were able to catch as soon as the downtrend was going to start. Falls back down, and then it starts over again. This is stock movement, right? This is the 4 stages of price movement. And again, we're going to get into how we're going to use this in order to find the best time to buy a stock. Now, the first thing that I want to talk to you about is RSI. Remember, I was talking about the relative strength index. Let's just try to see if I can make this a little bit bigger. So, you can't see it right here, but what I implore you guys to do when you watch this whole video, this chart that I'm looking at is on stockcharts.com. I think at the end of this video, I'm going to pull a stock up in real time and give you an example of, what probably happened. And, when this video is old, you guys can determine whether or not it made sense and whether or not this was right. The RSI set to 14 days up here. You want to make sure it's always set to 14 days. The RSI will range from about 0 and it usually goes as high as like 90, right? For RSI, if a stock is up here, see where this is green? That means that the stock is overbought. It's overbought. See where I said it was too hot here? It was too hot here. It was too cold here. So let's take a look at this chart. Sorry about that. Let's take a look at this chart. This is a chart of Tesla, and this is from Tesla on Wednesday, May the 8th. So that was just yesterday. Look at where back here in July, the RSI told you this is way overbought. And look what happened. The stock fell. And then it hit this low point in the RSI where it went too low. That was too cold. Then look what happened. It started going up. It went up to the top, kind of hot, drops back down. So look at that. The very top, too hot. What happens? It drops in price. Same thing right here. Too cold. What happens when it's too cold? Overly sold. Then it goes up. So if you didn't know anything about trading and you just looked at the RSI, you can make a good determination that when the RSI is at the bottom, you should purchase because it's oversold. Or you can make a good guess that when it's at the top, it's overbought and you should sell. Now for this chart, sorry about that. For this chart, it's going to show you the 200-day moving average, which is this red line. And you can see that up here. I might be small on my screen, but this is the 200-day moving average. You also have the current price, which is the one right here. Current price was right here. The 20-day moving average was right here. And then I'm going to talk about how we use those. But just with the RSI alone, you could have determined good times to buy and good times to exit. All right. So hopefully that makes sense. Now, remember, we talked about the 20-day moving average. Now, this is what you should look at when you're looking at a chart. And this is a old Tesla chart. When a stock crosses the 20-day moving average, that's a good indication that you should start buying. So you see right here when the stock crossed up above the 20-day moving average and then it kept going up and it stayed above it, this blue line, it was good, right? That was a really good time to enter when it crossed that point. And then when it fell below the 20-day moving average, look what happened. It fell. Then when it went above the 20-day moving average again, what happened? It started going up. So you would look for a few things. One, the RSI is, the middle of the RSI is 50, which is right here. 50 is a okay point. It's not too hot. It's not too, it's not too cold. It's like right in the middle. Good. If you see something like this where it's okay, but you see this cross up, that's that time that we look to buy. And then we just wait until either the RSI tells us it's too hot, because still with the RSI, as you can see here, it went up, then it came back down. It went up, then it came back down. Even with the RSI being overbought, you couldn't just use this one by itself, because if you were to just use this one by itself and you got out, you would have missed out on this whole uptrend. That's why we want to use a combination of more than one of these things. So even though the RSI is telling us that it's overbought, we would not have sold this. We would have bought here at this very, 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 very low price. I think at the time it was $325. We would have bought at $325, but we would not have sold until about $750. So essentially we would have doubled our money, right? And that's a swing trade from December all the way to March. So that would have been a very, very long trade, several months, but we would have doubled whatever money we put in when we purchased here. And I apologize for that. Same thing here. I got an old chart just to have some historical data. So right here, this stock was above the 20-day moving average. As you can see here, fell a little bit below, but came right back. RSI was still pretty high, but we did come right back. When it fell below here, this would have been an optimal time to sell, right? You would have known, okay, let's get out. Way too much. Maybe I bought when it was right here. It went up to a nice good amount. When it dropped below the 20-day, I'm out of here. When it rolls above it, that might have been a good time to buy, right? But then immediately you would have seen that, oh, I bought here and it fell below. Let me sell again. You would have minimized losses, because look at where it went. Completely plummeted. But then look what happened. RSI super low. And even though the RSI tells us it's a good time to buy, we would have looked at our 20-day moving average to know, let's not buy until it gets into at least somewhere above here. So right here would have been a good indicator to buy at around 160, and then it would have went all the way up to about 210, and then we would have dropped, probably sold right here at about when it dropped below here. The thing is, as time keeps going on for this chart, the 20-day moving average will get higher and higher and higher. So we probably would have ended up selling right around like 195, 200. All right. And that's us using the 20-day moving average and also using the RSI in combination to determine the best entry and exit for these stocks. Now, I want to look at another chart. This is the same chart for Tesla as of May 8th, 2024. So this was yesterday. I want to show how just recently, this just happened yesterday, how you could have looked at this chart and possibly made money. So as you can see, for Tesla, it was very, 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 very hot last July. And look what happened. It fell below the 20-day moving average, fell here. If you would have bought here right above the 20-day moving average, also when the RSI dropped to the bottom, you could have caught this move right here at around 240, and then you could have gone all the way up to, looks like about 280. But of course, when it fell around here, around 260, this would have been your time to sell, but you would have used your indicators to determine. Now check this out. This looks just like our 4 stages of price movement, doesn't it? Right here, stage 1. This is where you would buy, right? I know I have a lot of stuff on here, but let me try to zoom in without moving the slide back and forth. All right, so right here, the 20-day moving average is here. You would have gone in right here, you would have bought. And then Tesla would have kept growing because, RSI low. We crossed the 20-day moving average. It would have gone up, 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 because we would have got in somewhere around, I want to say maybe 210. It would have gone all the way up to right around 260. And once it crossed around 250, 245-ish, it would have been dropping below the 20-day moving average. That would have been our indication to sell and get out. And then check this out. This is what I was talking about. This happened at the end of April, beginning of May. RSI is low on Tesla. This is as of, that's probably the end of April for this year. You could have waited right here and purchased. That would have been somewhere around, I want to say 170. It went all the way up to 200. And this is the 20-day moving average. Now, this hasn't happened yet. This is present day. Now, you guys could check this out. Today is May the 9th, Thursday, 2024. Now, you're going to be seeing this in the future. Now, let's see what happens. If Tesla continues to fall and it falls below the 20-day moving average, we would sell. If it continues to go up, 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 we're just going to ride it up until eventually the 20-day moving average meets it and it crosses below it. So again, you guys could pull this chart up, whatever date it is now, use exactly what I just said to determine what move you would have made and if your indicators would have told you exactly what to do. Because right now the RSI is starting to fall. It's around 50. And actually, I made this yesterday and took this screenshot yesterday. I could look at it for today, but I'm not sure if you know what, at the end, we'll pull it up and we'll take a look at it and we'll see where it's at. I think if you watch this video 30 days from now, this will be even more telling in that amount of time. So just the more that this ages, the more you can see this information was accurate or inaccurate. We'll see. All right. So this is how we use the RSI, the 20-day moving average, and let's take a look at our last indicator, the MACD. Now check this out. If you would have, this is Tesla, same chart. We knew the RSI told us it was too hot, fell. When it fell and the RSI told us it was oversold, it crossed the 20-day. And we knew that was a good time to buy. Same thing here. RSI is low, below the 20-day moving average. Good time to buy. We bought. We would sell here. We made a profit. Now look at the MACD. When the MACD line, this black line, crosses over the red line, same thing. That's a good time to buy. So when the MACD crosses like this, you purchase. Same thing, right? When the MACD line crosses over the red line, that's losing momentum. We know that this is a good time to sell, which actually, if you look at this one, the MACD would have told us to sell even before we lost the 20-day here. Same thing here. When it crosses up, that lets you know when to buy. And then same thing, if we're looking at the MACD now, it hasn't crossed the red line yet. And again, this hasn't happened yet. But if it crosses the red line, this might be a good indication for us to sell and get out. So again, hasn't happened yet. You'd have to look at this and determine whether or not this information was accurate. Okay, so to sum everything all up, we just did technical analysis, the most basic version. If you are a new trader and you just used RSI, the 20-day moving average, and the MACD, those can be used to tell you optimal times to buy and to sell. So let's sum it all up. So when to buy versus when to sell. When the RSI is below 50 or the RSI hits 30, which is the bottom, that means that the stock is oversold. It signals a good time to buy. If a stock crosses above its 20-day moving average, that's an optimal time to buy as well. For the 200-day moving average, that's the price the stock usually trades at for the last 200 days. Now, this is contingent upon a couple different things, but this could be a good time to buy when the stock is below this price, but it can also be a good time to buy when it's above it. It depends. That's why I didn't really talk about that one too much, but I like to know what the 200-day moving average is, because that'll give me a good idea of, it might be a point of support or it could be a point of resistance. Now, MACD, that's a buy signal when the black line crosses above the red line. Now, when to sell. When the RSI is above 70, that means it's overbought. As you saw, the RSI can get as high as 90. So that isn't the only way that you're going to know that it's time to sell, because things can be overly bought. But it's a good indicator. When the moving average, the 20-day, when a stock falls below that, that is an optimal time to sell. That is usually, that in combination with the RSI is an optimal time to sell. The 200-day moving average, again, if that's the average price that a stock trades for the last 200 days, could also be a good time to sell when it crosses above or below that, but that's not always the case. It depends. I think it's something good that you can use, because sometimes that can be used for support and resistance. So, take that with a grain of salt, because it can vary. Now, the MACD is a sell signal when the black line crosses below the red line. That is a good time to actually sell. That lets you know that volume is leaving and that we're going to be looking at it going down. Now, before this video wraps up, I'm going to go to stockcharts.com and we're just going to take a look at the chart. But when you set up your chart, if you need to screenshot this, if you need to pause this video, go to stockcharts.com and pull it up. This is called your overlay. This is going to be how your chart is set up to look like mine. So RSI at 14, you want to set the indicators to RSI 14. MACD will automatically be set to 12, 26, and 9. Your exponential moving average, which is 20, will need to be set. Your simple moving average you can set at 50. I usually keep them all, and then simple moving average at 200. You can also use the simple moving average for the 20. That depends on your preference. Okay. You then update the chart, and then that chart should look very similar to how this chart looks, and that is how you set up your chart. Now, for the final step, let's go over to stockcharts.com. We're going to take a look at Tesla in real time. All right, so this is how it looks on stockchart.com. You're going to enter your symbol here. You don't have to enter just a symbol if you don't know it. You could just type in the name of the company. So let's type in Tesla. And right here it says Tesla Inc., TSLA. That's the ticker symbol. All right. So I'm going to zoom in here and let me set up the chart. Let's set up the chart so that this makes sense. So we're going to scroll down here, same as how I showed you before. This is the price indicator. I'm just going to change this to none. Again, you can change it to what you would like to change it to. I'm going to keep MACD the same way. RSI is going to be set to 14-day. Let's do exponential moving average. 20 is fine. Simple moving average. If we don't want that, we don't have to have it for the 50-day, but I'll just leave it like this. And then we go to update chart. And a couple things need to be changed. Let's move the RSI from the position to above. So that way this looks a lot neater. So here we go. RSI 14. Our chart. Let's do, I prefer candlesticks. All right. Let's do our simple moving average blue. That's just the color that I just like. So now we're looking at Tesla for today. Right now, we are right below the 20-day. It's at 172.42. The RSI is at 49. That's somewhere in the middle. If it was low like here, this would be an optimal time to buy. I would say that if Tesla were to close right below our 20-day moving average, it's so actually close right now. I would wait for this to actually close. This is a good time to sell. But come back to this video, when the RSI is at around 30 or it's below here, and then we see that the moving average, this stock moves above, that would be an optimal time to actually buy. So if we're looking at it right now with the RSI being where it is, with Tesla being below the 20-day moving average and the MACD getting ready to cross over, Tesla looks like it's about to go down. So if I was trading this stock right now, I would say now would be a great time to sell. This would be a good time to sell because it looks like it's below the 20-day moving average. The MACD tells us that it's time to sell. The RSI is telling us right now it looks like it's time to sell. So try this same thing in like around 30 days and look for the RSI, look for it to be moving above the 20-day moving average, and for the MACD to be crossing over where the black line is crossing over the red line. That'll be an optimal time to buy, and potentially you could look at making a profit. Now, this is very basic trading. There are a lot of other indicators. There are a lot of other tools. There are many different ways that you can do this. And there's also strategies that you can use where you can kind of like even dollar cost average into your position to where you could do better, and you could set what we call limits, where at certain times things will automatically sell and at certain times things will automatically buy. And you don't have to sell your entire position. You can just sell a portion. So for example, when the RSI hit the very top, maybe your strategy is to sell 25%. So you got 25% of the highest profit, but 75% of your position is still into the trade. You could then say, okay, well, at the very least, I made the 25% profit. If it keeps going up and the RSI hits 90, I'll sell another 25. And then when it starts to fall below the 20-day moving average, I'll sell the other 50. That way you're locking in profits as everything's moving. There's a bunch of different strategies that you can use. In future videos, I could talk about that. But this video has gone on longer than what I would have liked. If you guys like this video, if you want to learn more about stock trading, more than just the basics, and you want me to get into any details, please like, comment, subscribe. Let me know if you learn anything from this video. Let me know if you think from watching this video you feel confident about trading in the market, and if you think you could show this to like a 9 or 10-year-old and even show them how they can trade. Thank you for everything. I appreciate you guys watching. Channel is amazing. The community is amazing. I heard what people wanted from the passive income video, just releasing that yesterday. So immediately I was able to jump on this so I could show you guys this. So whatever it is that you're looking to, understand, as long as it's something that I'm familiar with, I'll be willing to show you, to hopefully get you to, create more wealth, have a better financial understanding, and just better overall financial health. So thank you for watching, and you guys have a great day.